Merci, Monsieur Caron, pour vos bons mots. Et merci, José, aussi, pour vos bons mots. C'est un grand plaisir d'être parmi vous aujourd'hui pour discuter nos prévisions de l'économie mondiale, les issues, the key points, les faits saillants de l'économie mondiale. I'm going to make my comments all in English. Mais si vous avez des questions en français après la présentation, n'hésitez pas. So we have a very interesting world at the moment, don't we? In my career, I don't know that I've ever had a more interesting period of time than, say, the last 5, 6 years. But then I think about it, and I'm pretty certain that I've had a pretty interesting ride for the last 20 years because when you think about how we were set up for everything that we've gone through in these last 5 years, it's taken a long time to actually get the world economy to the point where we could experience some of the things that we have seen over this while. So I'm one of those people that believes that if you don't know what has happened, if you don't know really where you have come from and how to understand history, and what point you're actually at this point in time, you have no business going out there and doing a forecast. And the trouble that I find is that many actually don't appeal to that long view of things. And so they're starting at the wrong point. And so our desire at EDC Economics is to give information that we believe is as close to the facts as we possibly can get with this perspective in mind, because we take very seriously that when we stand in front of an audience of decision makers, you're going to leave and you're going to have to put money on the table. You're doing this all the time, but we want to be useful in that sense. And so the information that we give, we take very seriously around our table at EDC in preparing that, because we know that the impact of it is potentially very strong, very consequential for your companies. So where is it that we've come from in a nutshell? Well, I believe that the world economy saw a very unusual period of expansion prior to all this craziness happening. We had about a 16-year growth cycle out there. Normally we would have 8. And at the end of an 8-year cycle, you would normally have a buildup of excesses inside of the economy. And those excesses happen because towards the end of a cycle, somebody like me, not me, but somebody like me comes along and says, it's different this time. And what that does for us is it says, well, if it really is different this time, and if growth is now going to go on for longer than it normally would, we can maybe lower our risk threshold. We can take a little bit additional risk. And so that's what kicks off a flurry of excesses. And normally those excesses would last a couple of years, and that's what sets us up for a recession. There's too much stuff in the economy. So we need a period of quiet so that we can use those things up. Well, if we had a double length cycle last time, then it poses a very interesting question. What happens to that extra head of steam on the economy? Well, this time around, it wasn't just a double head of steam. It was a 5-year period of excess inside of the global economy at the end of the cycle, right up until 2008. Now, this one was a little bit different than before because we had a 5-year excess that was very well publicized in the United States, a consumption excess. Everybody was doing crazy things, and mortgage lending was going wild. But when you add a globalized economy to that, it was not just Western consumption excesses. These actually became emerging market production excesses. Everybody geared their activity to this excessive activity. In effect, what happened was the excesses were exported everywhere. So the whole world was caught up in this period of excess. And it looked for a while like it was a new normal. That's what people were saying at the end of the cycle. Well, maybe we can actually sustain this overactivity. Maybe something has changed fundamentally so that this is not excessive at all. And after 2-3 years of this, it's beginning to look like, that it is a new normal. So people were very compelled by that story. But a moment always comes along, a moment of realization, where if you have too much stuff out there, people say, well, I don't really need any more. How many cars can I actually have? We joked, actually, that the reason there was so much home buying in the United States, so much excessive home buying, was they needed more garage space for all the cars they were buying. And so the bubble burst at a particular point in time, and nobody really knows when or how this realization sets in, but it's essentially because you have too much. And so somebody decides to haul in, and everybody says, oh, maybe it's not so sustainable after all. And that's what kicked off the greatest recession that we've had since the Great Depression. 5 years of excess is a long time. If a normal growth cycle is 8 years, and you have 5 years of excess, then that's huge. And then export that to the rest of the world, and it takes on a far greater significance. So that's why we had that big recession. And we panicked so much when that recession came on that we resorted to extraordinary policy, extraordinary fiscal policy that the world has never seen before, I believe, and extraordinary monetary policy to stimulate things back to some sense of normalcy. So they were very effective when they came in, but they came in far too soon, because the world was about using up those excesses that had built over the 5-year period of time, and they thought they were going to get over that in 6 months with all of this stimulus. Very wrong-headed thinking. And that's why I believe we have had 5.5 years of flat. In fact, we are lucky that all we got was flat and not another recession, because we still had a massive mountain of excesses to work down. So that's the context that we find ourselves in at the moment, but we have a very interesting question to ask ourselves right now, because if we had 5 years of excess and we have now had 5 years of flat, what are we in for now? What is the story that we get to deal with? Well, Canada and Quebec have been very unusual economies inside of this whole continuum. We had a jobless recovery in the 1990s that was very protracted, when the federal government was retooling fiscal policy and downloaded a lot of its problems to the provinces. Well, we effectively had our period of flat well ahead of everybody else. So we got our fiscal house in order, and we lost half of that growth cycle. And so we picked up at the end of that growth cycle, but when it came to 2008, we did not have the same kinds of excesses in our economy that others had. We had actually been in excess of activity, almost to the same tune as the United States was, except when they started their excess of activity, their economy was balanced. We were making up for lost time in the 1990s. So when we got into excessive activity, it was to fill the hole that was created in the first half of the 1990s, as opposed to overabundant excess of activity. So we came into the recession very balanced. So when our housing market corrected, for example, compared to the United States, we were still 3 times greater activity than they were inside of their housing market. That's the lowest level that we got to. And we didn't stay there for very long. We actually rose again. What happened, in a nutshell, to Canada and to Quebec over that period of time? When world trade collapsed, Canada lost a quarter of its trade instantly. And we're a trading economy. That's a terrible thing to have happen. But we had a domestic economy that could actually take stimulus and keep the economy going. And everybody was looking into Canada, and they were looking into Quebec and saying, what is this miraculous economy that you have here? There's nobody else in the OECD that's like you. You have good fiscal policy, you have great banks, you have lots of resources that the rest of the world wants, and you also have this domestic economy that's doing very well. Except our domestic economy is not doing too well now. We kept ourselves going with an accumulation of debt. So when you look at our debt situation in Canada, and it's not too dissimilar in Quebec, our consumers now, their debt as a share of their disposable income is now north of 150%. America peaked at 163% just before the crisis happened. So we're not quite as bad as them, but this is not a good situation to be in. So 60% of the Canadian economy, and it's the same for Quebec, is distressed at the moment. We kept our economy going, but we did it on debt. Now, our net asset position is not bad, but beware, because if our housing market is not doing well over the next little while, a lot of our assets are tied up inside of housing. So how is housing doing? Not too well. What this chart means here is the demographically sustainable amount of house creation in Canada. That's just a truism that comes out of our demographics. That's the amount of household formation, net household formation in any year. It's about 185,000. That's maybe a tall estimate, but let's use that at the moment. So here are the actual amount of new houses that are being created inside of the system. So just to illustrate, this was our period of excess. But remember, we had a great big period of underbuilding before that, okay? So what I'm saying is this area under the curve was equivalent to what was created up here. We had hardly any excess when the housing market plunged and the crisis occurred. See how quickly we came back. Policy was very, very effective inside of Canada. But when you see that most of the building is above the line and not below the line here, we have been creating excess. So what I've done is I've started from about 2011 and said, what is the accumulated excess over this period of time? And it's about 500,000 units. If all we need in any given year is 185,000 units and we have 500,000 units of surplus out there, we have a problem. So not only in consumption do we have a problem, 60% of the economy, but another 10 or so percent of the economy in housing is in trouble as well. Our domestic side is not doing well. The other part of our domestic economy is the government. Now, the federal government has done a good job of getting its books back in order, and it's almost ready to publish a surplus. So that's a very good achievement. Everybody in the rest of the world is lauding Canada for how federally we manage our fiscal situation. But when you look at the provinces and where their deficit situations are still at, Quebec is not the worst sinner here. You know, Ontario has that distinction at the moment, but it's not a good situation to be in compared to where other world economies are at and compared to the federal government here as well. So we are still in austerity mode. The point here is we don't have growth coming out of consumption, we don't have growth coming out of housing, and we certainly don't have growth coming out of the government sector. Those are the three key pillars, 3 of 4 key pillars, I should say, of the domestic economy inside of Canada. I've not talked about business investment for a very good reason. So if growth is going to come from Canada at the moment, if Quebec is going to generate growth, where is it going to come from? If it's not going to come from these sectors, it has to come from exports and export-related business investment. That's the big question that's in front of us right now. Is that going to happen or is it not? Well, that's where we turn first to the world economy and find out, okay, what is going on the world stage? Very quickly, how do we add things up? Well, you read the newspapers every day, and there's lots of stuff to worry about. 5 years on, after the crisis occurred, there still seems to be lots of weather trouble, lots of geopolitical trouble that's out there. There's a lot to worry about. There's a lot of flat activity, and it's persisted for quite some time. There's those who are out there that are saying, well, you know, if things have been this flat for 5 years, that looks like a trend to me, so maybe it's a new normal. And you hear a lot of talk about new normal out there. I think, I'm not so convinced it's new normal. 5 years of up, 5 years of down. It's happened before. It's biblical. That's just the way the world cycle works. So we have to ask ourselves a question. Is this just an exaggerated cycle? And if it is, you can throw away some of that new normal thinking or all of it. So what do we say then about this world economy? Well, I've got a similar chart here for the American economy on the housing side of things that is very revelatory because you can see illustrated here the ups and downs of the world economy. This, by the way, is a leading indicator of economic activity. Well, you might say, okay, well, if we're in a new normal, we're never going to get back to there, and this looks sort of reasonable, and maybe the U.S. housing market has corrected. Except inside of the U.S. housing market, this is their demographic requirements line. Look at how dramatic this is. Look at the immense pileup of housing that we see here. And inside of this green series, you can see the accumulated series, a massive overbuilding of house, years worth of housing surplus sitting there. But look at the extent of the correction. Nobody ever expected this to happen inside of the U.S. market. And to have it stay there for so long, 500,000 units. That was about a third of the equivalent building level inside of Canada at the same time. And for that to stay down there illustrates the extent of the surplus that actually built up. Well, now they're growing at a rate that's about 20% year over year. And that's pretty important that a leading indicator would be there. But they haven't even got anywhere close to this. They've still got 40 to 50% growth left inside of this that could occur easily over the next 2 years. Well, what's significant about that? Why do I pick on housing in the United States? I've already said it's a leading indicator of activity. It's the one that gets out there first. So it's still got 40 to 50% growth to happen over the short-term period of time. That's a very strong indication of where the U.S. economy is going. Now, why do we get excited about housing? It's not just because of building. Yeah, it's great for the wood industry, it's great for copper piping and all of the things that go into a house. But what excites me even more is what goes into a house after it's completed. All the appliances and the furnishings and so forth, that's a much bigger component of overall GDP. Every new house needs one. And if this is growing at a 40 to 50% clip, then all of that appliance activity is growing at a 40 to 50% clip as well. Now, autos have already recovered in the United States. They're way out ahead of the pack. And so housing is following behind a very, very strong sector and a good indication of what is actually going on in the U.S. economy. So that's important for us to know. What about the business side of things? This is really exciting too. When a world cycle happens and you have been over-investing to keep up with the pace of global activity, and then a recession happens, what occurs inside of a business? Well, all of a sudden you have all kinds of spare capacity. And you're not going to invest a nickel until that spare capacity is used up. And it takes a while to use up spare capacity when you're in a 5-year full-blown excess and then you see global activity drop as much as it did. You can wait around for a while. Now, the trouble is when business psychology gets to the point where you don't have to invest and that persists for a number of years, you get into a brand new mindset. You're not going to take any risks out there because you've had this great big comfort zone. Except over this period of time, American businesses have used up that activity. Stimulus caused a lot of that spare capacity to be used up very quickly. And gradually, not gradually, actually quite dramatically, but almost unseen, the rate of capacity has gotten right back up to where it was when that frenzied activity was occurring in the United States economy. Look at how razor thin the capacity margins are there. Now, in one conversation I had before we started the session this morning, I was told that the company is sort of bursting at the seams. There's not a whole lot of capacity left. This is a phenomenon that is not just a US phenomenon, it's a Canadian phenomenon, it's a European phenomenon, and it's a Japanese phenomenon at the moment. Investment has been on hold for a long time, and nobody wants to take the first step. But if everybody is at this point here, and you see the pace that orders are coming in at the moment through PMI indices, we don't have a whole lot of time to actually get our machinery going again. I believe that we are on the leading edge of a wave of global business investment. Now, normally when world economic activity recovers, there's a year or two of spare capacity, and so you can put your plans in place, you can get your new plant built, you can order your machinery and equipment, and it's all there and available for you when you're ready to do it. This time around, it's all going to happen very quickly and very close to the actual growth occurring. There's not going to be much time to react. And the difficulty is when you finally decide, okay, we better get out there and do something, everybody else is going to be saying exactly the same thing. There's going to be an instant realization that this growth is the real thing and that we need to get out there and really harness it. The difficulty is going to be, am I going to be able to get the machines that I need? Am I going to be able to have the construction in place to be able to put this new plant up? I believe that, our problem is not so much worrying about what next risk is going to happen, but actually securing the resources to create the capacity that we need to fill all of these orders in. And this is illustrated by what's going on in the US economy at the moment. It may not be obvious to you, but there is actually quite a strong trend already in the United States with respect to business investment. The only reason it shut down in the first quarter, that was a weather effect. But the quarter-to-quarter rates of growth on both machinery equipment and structures is very strong. And the fact that it's strong in structures at this point in time is very, to me, instructive, because it normally waits. There's normally a big lag there. And this isn't so much a lagging indicator anymore. It's a very contemporaneous indicator. So things are happening in the United States, and I think we need to be very aware of those. What it's telling us is there's a lot of pent-up demand in the economy. Folks, consumers, those who want houses, those who need to invest in plant and equipment have to do it. There's an urgency to it. But here's another fact about the US economy that I think is thrilling. Americans are the world's optimists, right? There's nobody that's more glass half full than Americans, right? They're ready to put their money out on the table. They have the best venture capital market in the world, bar none. Nobody does it like them. They love risk. And I think it's because of the way their country developed. It was the frontier mentality. You know, the government would give you the land, and they would make the cavalry ready, you know, to come to your aid. The rest is up to you. Go and get it. And so you have the right to bear arms, but it's really up to you. It's a true frontier. And that has created a spirit of entrepreneurialism in the United States that doesn't exist anywhere else. So they're the world optimists. Have I convinced you? We all know that, right? Except when this occurred, consumer confidence in the United States went down to depressionary levels. We were terrified when we saw the depths to which the number was falling over here. Never happened before in other major recessions. Never seen before in the entire series. So that was an awful point for Americans to get to, but they recovered quickly. They recovered to recessionary levels of confidence and stayed there for 5 long years. Totally unlike Americans. Normally they're schizophrenic when it comes to recessions, right? They can't decide whether they're pessimistic or they're optimistic again, or pessimistic or optimistic, or pessimistic, and finally they get over it. That's the way Americans normally behave. And you see the same pattern of activity happening in the 1990-91 recession. This time around, they were down and they stayed down. They stayed in this zone 3 times, 1, 2, 3. They tried to recover and failed. And after the 3rd time, I started to lose hope that their confidence was ever going to come back. Halfway through last year, it happened. They burst through the zone without any policy announcement, without anything significant happening inside of the economy. They did it all on their own. And that was John Maynard Keynes' problem back in the Great Depression. The world was not getting confident all on its own. And so we needed to do something to get them confident again. This time around, it happened all on its own. And it's a good thing that it did, because we had no other policy instruments in order to lift things up. We had a real crisis on our hands, and American consumers and businesses solved it themselves by becoming confident all over again. And I'm happy to say that since then, absent the silly episode where the government was shut down last October, I thought, okay, well, they've regained their confidence. Now it's gone again, and thanks to the government. But they got over that, and even with the weather effects and everything of the first quarter, they've continued to build on that confidence. That's one of the most significant things that has happened in the world in the last year, as far as I'm concerned, because normally this just doesn't happen. This is why I think it's not such a new normal economy. We are getting back to normal levels of confidence, normal levels of activity in the #1 economy of the world. It is resuming its role of global growth engine. And if that's the case, we all need to be ready for that growth, because the engine starts and it pulls all of the other cars behind it. And I believe that's exactly what is happening at the moment. So here is the trend of quarterly GDP growth in the United States. This isn't something to be worried about. That's a weather effect. They got over it very quickly, and we expect very strong growth for the remainder of the year. And we believe this time it's the real thing. Okay, that's 19% of global GDP. 21% of global GDP is Europe. And Europe, the big question there is Europe back in recession? Europe got over its recession in the middle of last year. Everybody's really happy about that. Italy posted 1 quarter of positive growth, and they're now back into recession, as you can see in the chart here. Germany has posted a negative quarter of growth. Germany is the engine of Europe. That's a big concern. France is flat. And they're making a big deal of this by saying, we have a nice stable economy. Stable at 0 growth is not stable, folks. That's a bad situation to be in. And they have their political problem at the moment. Okay, these are the 3 leading economies in Western Europe. What is going on? Have we got something to be worried about here? Well, we have to ask ourselves the question, is this just the fundamental problems that Europe has with respect to fiscal policy, with respect to its banking sector and so forth? And many retreat into that and say, well, this is just going to be the European story for the next little while. I'm sorry, but nothing has changed on that front to cause them to dip back into recession. We knew about that before, and they're actually continuing to muddle through those problems, and they're doing very well. I could put a chart up there that shows you that Greece has posted a balanced budget 2 quarters ago. Now, they're not sustainably there, but the fact that they were actually able to generate a 1-quarter surplus 5 years on, when many said it was going to be 20 years before Greece could achieve this, is monumental. They're not the only ones. Portugal is there. Ireland is there. Everybody is seeing vast improvements in their fiscal position. Germany was leading the way to begin with. France is not doing as well. The UK is not doing as well. But most of the economies, their austerity programs are paying huge dividends. And nobody's saying anything about it because there's a lot of embarrassment about how quickly this has been achieved. But this is a very strong indication of where Europe is going. So I'm not so worried about those fundamental problems. The banking sector, I could go on ad nauseum about how much better capitalized the banking system is now. They've taken Basel III seriously. They've taken domestic regulations seriously. And they've put themselves on a much firmer footing. That's not the problem. It's not the fundamentals as far as I'm concerned. So what is it? Is it Russia, Ukraine? Possibly. Although I think I've got evidence to refute that. If you look at confidence inside of the economy, yes, confidence has turned down, but look at the kinds of levels that it's at compared to the past. Europe has rediscovered its confidence too. And there will be ups and downs that actually happen with respect to Russia-Ukraine type situations. But I'm not terribly worried about all of this. I think that part of Europe's problem at the moment is they are experiencing a 1-quarter reaction to the shutdown in America in the 1st quarter as a result of their weather situation. And they're going to get over it. Well, we're not the only ones that feel that way. If you look at the consensus forecast for Europe, everybody is expecting much stronger growth for the remainder of the year, and the consensus forecast for next year is 1.5%. No change from our spring forecast, in spite of all that's going on with respect to GDP growth now. I don't think we have a whole lot to worry about. Europe will not be a leader, but Europe is not falling apart at the moment, notwithstanding the problems that are actually occurring over there. So here's another 21% of world GDP that is not inhibiting world growth. It's actually playing ball with America's rise. Japanese businesses are also very upbeat. They have lots of reasons not to be. Japan's structural situation is very poor. They just have a massive tax that was levied on the consumer side of things. But businesses are still seeing a whole lot of optimism. The optimism ticked down in the 1st quarter. That was because of the US weather effect, and we believed that that was going to be transitory, and the latest survey has actually substantiated that. So relatively high levels of confidence inside of Japan. And you can see how Japan has struggled with confidence over this 5-year period of time that the world has gone through. So I think put all of that together, and you've got a very serious chunk of world GDP. That's another 9% of global GDP. So add those 3 zones up, and you've got a significant amount of the world economy right there. And we believe a world economy that is getting back on its feet again in a very remarkable way. What about emerging markets? Well, I could go A to Z on emerging markets, and I'm not going to do that. Where is the growth dynamic inside of these markets? Many are talking about China and China's growth faltering and all the bubbles that have built up on the financial side of things, sure. I mean, but I think that's a sort of a myopic view of China, if I may say that. The story in China is that when the world economy collapsed, China is a trading economy. And sorry about these digits down here, but that's 2008. And you can see this trading economy collapse in an awful hurry. China realized that this was happening, and China panicked. And the reason that China's stimulus programs were so much more dramatic than anybody else's anywhere in the world, put fiscal and monetary policy together, and they stimulated their economy in the 2009-2010 period on the order of 25% of their GDP. The average OECD fiscal stimulus program was 3.9% of GDP. So Japan or China again blew the rest of the world away with drama in terms of the way that it stimulated its economy. Why did it have to do that? Well, if you lose that much of your trade, if trade was 62.5% of your GDP and it falls to 42.5% of your GDP, you've got a colossal problem. And people started worrying, jobs started being lost, the real estate sector started to implode. China came in there with policy and filled the hole that was left with by international trade. And that hole hasn't been repaired in the intervening period of time. So this is the EIU forecast of Chinese trade going forward. But it doesn't take into account a recovery in the rest of the world. And I believe a recovery in the rest of the world will actually elevate Chinese export activity, not back to the levels that it was at before. You can see the frenzy years illustrated here. But if this is the trend that it was on, even if you go halfway back to that trend, you've got very aggressive Chinese trade growth for at least 2 years, on the order of about 20 to 22% a year. Now, that's not unusual compared to what was happening prior to the crisis happening. Well, if that occurs and gets the Chinese economy going, well, the policy can dial down and China can still see growth of 8%. We believe that for next year, 8% might be on the light side. That puts us on the top end of the consensus. Nobody else is of this view, but we believe that this is actually going to occur. And that's going to be good for that entire section of the world. We'll see it looking much more normal next year than most are believing. Not all emerging markets are in the same place. Obviously, Russia has its problems, a very dangerous place to do business at the moment. EDC is actually off cover for Russia at the moment. Brazil, all kinds of problems. Brazil could grow, but it's just not creating enough capacity to grow, so we expect slow growth there. So, what are the reasons we believe this recovery is real? Trend growth is very strong. Leading indicators are pointing up almost universally. There is lots of pent-up demand. I've made that argument inside of the US economy. Confidence is back. Austerity. Well, if governments are actually repairing their fiscal situations, there's no need for additional austerity that's holding us back. We're actually getting a government sector dividend going forward just because they're not deepening their cuts. You know, they don't have to start spending in a frenzy. All you have to do is stop cutting. And when you stop cutting, you actually get that bonus in the economy. And of course, nobody would be talking about the end of quantitative easing if it wasn't for growth. Those two things have to go hand in hand. Well, just yesterday, the Fed said we're going to reduce our purchases by another $10 billion. So that quantitative easing program is dialing down. It's continuing to do that. And there's actually a lot of talk about interest rate increases occurring. Okay, so in a nutshell, there's too much information up here. But this is a world economy that's getting back to 4% growth. And really up at the top line there, it's the US economy that is leading that forward. So if you have any questions about that, please let me know. Okay. I got to keep moving here or we're never going to get out of here. I'm just trying to decide how to do this quickly. We've got a world economic situation here that I've illustrated for you. If that is indeed the case, that's the key behind Canada's export success. You've got to have global demand to be able to feed into. If that's not firing up, we don't have a hope. But we still have a question. World demand may grow, but is Canada going to get a piece of the action? Well, where we have to start, I think, is with our dollar. Let's actually ask ourselves, is there anything reasonable behind where the Canadian dollar is going at the moment? I've got to go through this. I'll try to go through it really quickly. This is how we believe quantitative easing came into the economy. When the crisis, prior to the crisis occurring, companies were very good with their cash. They weren't, I mean, might have been in excess activity mode, but companies were actually stocking up their bottom lines quite nicely. When the crisis occurred, cash became king. Everybody was worried about a freeze-up in liquidity. And so there was cash hoarding that happened inside of corporations of all stripes. And on top of that, in order to ensure that we weren't losing confidence in our financial system, quantitative easing was introduced. And vast amounts of liquidity were injected in 3 waves into the world economy. So we have to ask ourselves, where did that money go? Well, nobody really wanted it. Consumers weren't getting into the mortgage business. They were trying to deleverage themselves. They weren't maxing their credit cards out. They were actually trying to get their credit card bills paid down. Businesses did not have to borrow because they had all of this excess capacity. So with all this money going into the economy, where did it go? Well, the average CFO, you know, the shareholder was saying, we need a return on all of this cash. You can't just put it in a bank account and get no interest on it. Get out there and do something with it. There's not regular business activity to use this money in. Go and invest it. Well, CFOs are pretty conservative people, so they went out into safe instruments and they drowned the bond market. Price of the bond went up, the yield went down, no return. And so they had to keep going further out on the risk spectrum. And finally, they got into those dangerous investments. All this parked money got onto the periphery of the market, into the stock market, into carry trade currency plays, into risky emerging market paper, and finally into commodities. You think commodity prices have been real for the last 5, 6 years? I don't think so. How could you have weak activity worldwide, high and rising inventories, and high prices? Those things don't go together. There was distortion of prices on a massive scale that happened at that time. Now, we haven't just started to say this because it's convenient to explain why world activity would be rising and commodity prices would be going down. We've been saying this for 3 or 4 years now. Now everybody else is singing out of the same songbook. I'm not trying to pat ourselves on the back, but our profession did not do a good job of analyzing what was happening with all this liquidity. So what happens when a world market starts to come back? Well, all these CFOs have this stuff out there, but now they're seeing, okay, well, maybe we need this cash back for regular activities. So they might repatriate this to regular activity through the financial transmission mechanism. They might go through the bond market, or they might just leapfrog it altogether. The point is that all 4 of these areas are under threat. Not so much stock markets, but all these other things, I believe, are under threat. And this has actually manifested itself in the last little while. That's why we have oil prices going down. That's why copper prices are very light at the moment. That's why other base metals are not doing particularly well. Outside of abnormal supply disruptions, the fundamentals would say there's a great unwind going on from this unrealistic pricing that we've seen over the last little while. And for all intents and purposes, that's why gold prices are going down as well. And we actually see triple-digit gold prices in the not-too-distant future. Why do I say all of that? Well, commodities drive our currency. It's really the number 1 factor. It's the number 1 and 2, actually, inside of our model. And so if those prices are going down, logically, the Canadian dollar should be losing steam. Thirdly, we do not have to raise interest rates as quickly as the United States because as our export sector and business investment sector is rising, we've got this weak domestic sector. We've got an offset in our economy that means the Bank of Canada doesn't have to have an itchy trigger finger on the monetary policy gun. I believe that the U.S. is playing with fire at the moment, by the way. I think they're getting themselves seriously behind the curve. And we can talk about that in Q&A if you want. But this is another reason why the Canadian dollar can be weak over the next little while. Just the interplay of monetary policy. U.S. dollar movements. Well, with the U.S. being the strong economy out there, and the one that everybody seems to want to go to as a safe haven anytime there's any kind of global disruption, we believe in a modest appreciation of the greenback against all currencies. And of course, we're on the flip side of that going forward. So another reason for weakness. Finally, Through this period of time, Canada has attracted a lot of attention because we've had all these things going for us. So we've attracted a lot of portfolio flows into the economy. That's not quite the halo's not as bright as it was. And so that's actually a negative factor as well. That's why we believe the Canadian dollar is going to hover in the low 90-cent range for the next few years. Some are saying it actually will go as low as 85 cents. They've jumped onto the bandwagon, and then they really believe that this is going to happen. I think with the achievement this year of a merchandise trade surplus for the first time since 2011, and really for the first time since the pre-crisis period of time, there is going to be some portfolio interest in the Canadian dollar. And this is something that is just in the works right now, but it looks like we're going to post a sustainable merchandise trade surplus this year. And so this is a bit of a question mark. But anyway, we believe that for all intents and purposes, Canadian and Quebec exporters can count on a Canadian dollar that's hovering around the 90-cent level. So the dollar is in good shape. What else is going on? Well, we have free trade agreements that are happening at the moment that are increasing Canadian opportunities. This is the CETA. And so this is a structural study that was actually commissioned by EDC, but it's the one everybody is referring to at the moment. And here are the sectors that are expected to see the greatest gross gains. So processed foods, a big one for the Quebec economy. Textiles, of all things, another winner for the Quebec economy. Numbers 1 and 2 up there. And that's not all that we have going for us. There are other sectors that fit into the Quebec story, particularly construction, a very great comparative advantage inside of the province as well, the commission notwithstanding. Here are the net benefit areas, and so you can see that while we gain from processed foods, of course Europe gains as well, and much more than us, so there are some industries that will be under threat. But when you see metals, you know, another area of Quebec superiority, particularly on the aluminum side of things, motor vehicles and parts, other transportation equipment, the aerospace sector, these are the greatest areas of net benefit that we see from CETA. Then there's the Korea Free Trade Agreement and the other free trade agreements that are being discussed. You know, India may happen under the Modi government as well. That's another structural reason why we believe Canada's trade is on a good radar screen around the rest of the world, and so we should be paying attention to that. I will also say that there's another phenomenon that is happening inside of Canada that Quebec exporters, you around this table, should be focusing on as well. It's the diversification of trade to emerging markets. Now on this score, Quebec's record hasn't been the greatest. Quebec, in terms of its international diversification, was close to last in 2000. So the starting point wasn't great. But what I will say is that in terms of the progress between then and now, Quebec is one of Canada's top economies. In terms of the relative gain in diversification over that period of time, it's among the top. So the starting point was lousy, but the finishing point is indicating that something very strong is going on. So from having only about somewhere between 3 and 4% of Quebec merchandise exports going to emerging markets, it's now 15% of the total. That's pretty cool. So whereas Quebec's total trade growth over the last 14 years, and I didn't extend this out, but it actually does go out to, 2013 inside of my chart. Same même tendance. What this chart illustrates is, here's where Canada's traditional trade has gone over this period of time, about 1.2% a year, nothing to write home about. In fact, it's a full-blown crisis for a trading economy. But when you look at what has happened to emerging markets, this is the trajectory that things have been on. Now, for the last 5 years of the last growth cycle, it was actually on a much greater trend. And we believe that this is the one that actually keeps pace with how OECD nations are trading with emerging markets. What does it all mean? Well, from a very low share of emerging market trade back in 2000, Canada as a whole has about 12% of its merchandise exports going to emerging markets. That's a transformation over that period. If the same growth occurs into the future, by the time we get to 2025, this is going to be a third of our trade. Now, if we go with this high growth scenario here, which we actually realized at the end of the last cycle, Canada can do this, it'll be over 40% of our trade. You imagine a Canada that is actually doing trade that's that diversified? Can you imagine a Quebec economy that's doing the same? And given the change in the share inside of Quebec, that is totally achievable. The Canadian metrics apply to the province here as well. There is a lot of growth to be had, not just from this resurgent US economy, but from Quebec dealing with emerging markets in a brand new way. We are seeing this happen across industries and right across Canada. This is a very diversified activity that's happening. No industry is left out of all of this. And the hope that we have going forward, I believe, starts with very exciting sectors, like the aerospace sector, which is all over the world at the moment. We are setting new standards for the aerospace industry right here in the province. Machinery and equipment, high-tech offerings. But one of my most exciting is actually the tried and true old agri-food sector. And this is an illustration of how dynamic this can be going forward. And I wasn't doing this for any particular person's benefit, but this is the exciting part of all of this. We have a world that's back on its feet again. We have a world that has growth that can again cause the augmentation of the emerging market and middle class to resume. Do you know how many people China is actually adding to its middle class every year? Folks, it's more than Canadian population every year. It was 40 million last year. That's just China. India is adding between 10 and 20 million and a target of 30 million a year. Almost Canadian population every year going into the middle class. Brazil, 5 million. Indonesia, 7 million, and the list goes on. Now, what's instructive about moving into the middle class is that A, they consume more, and B, they consume higher quality. And the first place they start is food. They eat more meat in general. Now, if you're just going to consume grains, it's one thing. But if you're going to consume meat, it takes 8 times the amount of grain to actually feed that animal or what have you for the same caloric intake that you would get just from consuming the grains itself. It's a factor of 8 to 1. So higher meat consumption puts exponential pressure on the world's crops. And we are a breadbasket nation. We have so much opportunity on this side of things. We worry about losing our regulations and the walls that we've built around this industry inside of Canada. And I think we're crazy. Because throw all of those things away and we still have a world that needs what it is that we are generating at the moment. We have a vast food surplus all the way through the value chain from very rudimentary crops to the highest developed food products that we market to the rest of the world. The world is our stage. I believe this is a Canada moment. I believe this is a Quebec moment for us going forward. And I do believe that our greatest problem is not the next risk that's going to come along, but it's being ready for the growth that's coming our way and to competitively enter this marketplace and to realize the huge gains that are possible there. Okay, so that's on the positive side. I believe we've got a lot going for us in terms of our international trade, and if you look at how we've done over the last 8 months, the numbers are very, very impressive. They're impressive for Canada and they're impressive for Quebec. Every province, in fact, is participating in this growth. And I believe it's illustrative of our economy having turned a corner. That rotation and growth that the Bank of Canada has been looking for, I believe it's here. They're very cautious about that at the moment. I'm being a little less cautious about that and saying, I'm worried that this growth is so strong that we're not going to be able to keep up with it. Okay, what problems do we have? We have infrastructure problems. People haven't been able to get here this morning because of crazy bridges. It's driving you crazy, and I don't need to elaborate. That's probably the only illustration I need. And this is a pan-Canadian problem. You know, if our businesses haven't had to invest for years, our governments, the first place they go to make cuts, one of the first places is infrastructure, because you don't realize until a few years down the road that you've actually made the wrong decision. You can hide it for a while. And so that's where we cut. We cut defense, we cut infrastructure, we cut other things that are less visible, less painful. But we pay the price after a while. And we've got a serious shortage of trade-enabling infrastructure inside of our country. I just heard a presentation about 3-4 weeks ago. In Ontario alone, there is a $130 billion infrastructure deficit. I think Mario Lefebvre and his group have been enumerating this for quite some time. How much the infrastructure deficit is in Quebec, each province in Canada, it's huge. There's a lot that needs to be devoted to this. And we felt the taste of that last winter. Here's railway car loadings as an illustration. And I know that this is a sensitive issue here because of Lac Mégantic, but this is our reality at the moment. Railway car loadings overall have been pretty flat over this period of time, but the oil sector is gobbling up more of that capacity. And we felt the pain of that in the winter. We just could not move goods. Ships were waiting for months in some cases for their loads of primary goods out there. It's not just a Canadian phenomenon, it's happening in the US as well. But again, this is why I'm concerned about us being able to furnish this growth going forward. The last point I will leave you with is our demographic problem. We have a demographic problem inside of Canada, and it's actually more acute in Quebec. 2016 comes along, and the population 15 to 54, which is the bulk of the labor force, starts to decline, and it declines for 5 years. And I don't think we're ready for that. I believe that there are solutions. There are a litany of solutions for this, and some that you can actually implement inside of your own companies. But I'm quite concerned that we get to a point here where we're harnessing the world growth cycle and all of a sudden we run out of talent. And I do believe, in spite of this debate raging, that this is a critical problem. So we need to keep our eyes on that. Okay, let's wrap up this presentation and say, what are some of the risks out there? Well, we still have fiscal fragility. You know, if something T-bones world growth, that's a problem. There is still a financial sector that is vulnerable out there. We obviously have a litany of geopolitical concerns. Market opacity. You go into a place like China, you can't figure out quite how its banking sector works, and there are some risks surrounding that. None of these, by the way, are debilitating risks. There's the hidden protectionism, the neo-protectionism that came in when the global economy started to falter. That's still with us. Aging populations, I've just spoken about, and capacity to grow. That's my big obsession. Of all these risks, I really believe this is the greatest one that we face out there. So how do we wrap all of this up? Well, I'm a firm believer that global growth is back. Watch out, because domestic demand in Canada is not our strong suit. It's the export sector that's really going to do it for us. Keep your eyes on that business investment boom. It's something you can sell into, and you can also take action by saying, okay, well, I need to get out there and invest because I know that this growth is coming our way. Infrastructure we've gone over, and labor, you got to love them or you're going to lose them. And that is the end of my presentation. I've spoken for longer than I thought I was going to, but I hope that you found that that was useful for you. And so now is your turn. How much time do we actually have? Do we have a few minutes? A few minutes more. Yeah. A few minutes more. I was asked if I could stay around till 9:30 actually, but if you have to go, I'm not going to, you know, the doors aren't locked here, but please, if there are any questions, I'd be more than happy to answer them. Yes?
What do you think is the next changes in interest rates in the U.S. and in Canada? How do you think this is going to affect our economy and the commodity and resource economy?
Sure. That's a great question. I'm sorry I didn't elaborate on that, but I ran out of time. We see the, U.S. interest rates rising in, I think that March, April of next year is the first time that we actually see an increase happening. In the U.S., that's the U.S. Situation. It's not going to be until 6 months later that Canada starts to increase rates at that point. Now, I believe, if anything, there's a risk that the U.S. will start sooner and that Canada will actually go later. And so there's some downside for the Canadian currency in that story. But for Canada, the reason that the Bank of Canada has that longer tether is that we just don't have that domestic economy. We don't believe that there's going to be a domestic economic crisis. The export sector is actually going to keep our domestic sector humming along, but it's going to be low growth. In effect, it is a bit of a new normal, but I don't like to use that phrase because it's not anything structural that's happened inside of Canada. It's just the interplay of the way that we have enacted or the way that we have played ball with the economic cycle. So there's nothing new or normal about it. It's just, it's actually old normal. as I see it. But that's the interest rate story. Thanks for asking that question. Yeah.
Est-ce que vous croyez, vous avez dit au début qu'actuellement les cycles de croissance étaient de 8 ans. On en a connu une de 16 ans, puis après ça, il y a eu le gros clash. Est-ce que vous pensez que cette grosse crise économique-là mondiale qu'on a connue vient de changer la donne, où on retourne vers, vous avez dit, peut-être un gros cycle positif de 5 ans? Est-ce que vous croyez que la grosse crise économique qu'on a connue va changer la donne complètement, notamment dépendant du climat? On l'a vu aux États-Unis avec le climat en début 2014.
Oui, c'est une bonne question. C'est une thèse d'un PhD.
You can answer in English if you want.
Oui. Okay, well, I could answer in French,
Yeah,
but
that's okay.
maybe it'll go quicker if I answer in English. This is a great debate that we're having at the moment. There are so many astute economists who are finding reasons to say, you know, things have changed fundamentally, and as a result of the aging of the population, as a result of some of the structural weaknesses that came into the economy when the crisis actually occurred, that we are going to be held back for a long period of time. And there's a long list of those reasons. What I will say is, every time you have a protracted period of either strength in the economy or weakness in the economy, you're going to have people, right from, you know, armchair analysts to the most astute economists out there saying, here's the reason why it's different this time. Well, you don't have to go back very far before the it's different this time that they were saying was a high growth. It's different this time. And so I look at that and say, if I'm going to be able to look at myself in the mirror every morning, I've got to stand back from that nonsense and say, is it really? I mean, they have the burden of proof on them to prove that it really has changed this time, not me. Because as far as I'm concerned, the rule out there is the fluctuations of the business cycle, which essentially have not changed. And it's amazing how people will tear up their theses and throw them away so quickly as if they never said them before. And that really annoys me. So I think to myself, I am not convinced, you know, as somebody who has seen quite a few cycles in the last while, that this is really fundamentally any different. The drivers of growth are actually there. When you look at how suppressed growth is and say, we know that there is pent-up demand that is building. Every year this is a below-the-line sort of industry. You know, nobody foresaw the comeback of the auto sector. They just figured, okay, it's dead, it's buried, you know, maybe 2 out of 3 of the Detroit 3 are going to fall off the wagon here. That's how desperate things were at that time. And now the U.S. is on the verge of 17, 18 million sales of autos in a year. And they're, you know, they're just, okay, let's try to forget all of these bad predictions that we made about the auto sector before. So you see all these analyses that are done over time, sitting in my seat, and you get very frustrated with what passes as good analysis. And I think it's more important to stand back and say, how do you tell the story around this thing? And that's why I start off with the historical. I think it's so important to this whole story. And I'm a firm believer that the world has not lost its capacity to have a normal growth period, like a normal beginning of the cycle that is actually quite dramatic. And I believe in a year from now, we'll all be reading about it in the papers and saying, well, you know, where was all of that thinking about new normal? Like, what was leading us down the garden path, you know? We're back to what we would normally see. That's where I stand on that issue anyway, yes.
Knowing that the businesses here have the choice to deal with US or renminbi in China,
Mm-hmm.
What is your position, your take on the renminbi currency?
Renminbi currency is certainly an up-and-comer. It's remarkable how pervasive the currency is in the world economy at the moment. However, with all the gains that renminbi has made, in terms of the entire spectrum of global trade, it maybe covers around 8 to 8.5% of the entirety. The vast bulk is covered by US currency at the moment. So there were prognostications about the end of the greenback and how quantitative easing was actually fundamentally undermining the currency and so forth. I will say, one has to be really careful about what one says about quantitative easing because it was never done before. All those flow charts that I had up there, first time in history that we've ever had the opportunity to see this happening. And if putting it out there is unprecedented, well, pulling it back in is unprecedented as well. There's no playbook on that. Nobody knows exactly how this is going to unfold. So that whole process has led many to say, well, the greenback has been fundamentally undermined by the vast surplus of cash that is out there in the system, and it's going to soon be a bygone currency. That reasoning only works if you have a substitute that can stand in the place of the world's reserve currency. And the euro is not it. There's too many structural weaknesses there. The yen is certainly not the currency. Renminbi could be the currency if China's economy was more fully developed and if the currency was completely convertible. But the quasi-managed state of the currency together with the restrictions on its movement, prevent it from actually being a reserve currency. But even if those things were solved, I believe the maturity of the Chinese economy still holds it back from being that reserve currency, because until per capita incomes in China rise to the point where consumption is a powerhouse that can self-sustain the Chinese economy, and I believe it's still fundamentally a trading economy, then renminbi is going to be held back by all of that. We're actually writing a paper on that at the moment, though, because I believe that it's important to factor into business plans that there is going to be more RMB trade, denominated trade occurring. And Canada seems to be, if not on the leading edge of this, exploring what it needs to do to be on the leading edge of this. And I know that the discussion around Ottawa is very much around when are we going to see much more fluid renminbi transactions. But it's still a very minor player in the world. And in fact, if the doomsayers are right and it is the end of the greenback, God help us all, because there is no other reserve currency. We're going to be looking to gold or the creation of a new world currency or something crazy like that, because it really is our only option at the moment. Okay, I've run out of time? Or?
No, perfectly fine. First of all, let me introduce myself. And to everybody, bonjour, mon nom est Éric Tétrault, je suis président depuis lundi. Alors, je suis nommé, I'm the new guy on the block, and this is my first time being late, and I hope the last. Oh, but you talked about infrastructure, so thank you very much.
Yeah, I got you off the hook.
But there was also an accident on the bridge this morning, so all kinds of problems. I want to ask a question on behalf of all the members that are not here today. Mm-hmm. There's good news and bad news, and less interesting news about exporting more. The good news is Investment Quebec seems to be on track with that. We're talking with them, and it seems to be a priority, and we know it is. But they're telling us that our entrepreneurs are not really ready for this. They're saying they don't have enough qualified workers. They don't have probably enough machinery, equipment. If you were a Quebec entrepreneur, knowing the situation right now, what would you do?
Well, it's interesting that you asked that question, because Investissement Québec has asked me to come and give a talk to them that's something like this, but it's more along the lines of what would I advise them in terms of strategic direction. Now, they as you rightly say, have really jumped on the Exportation bandwagon, and that's a very good thing, because we see in terms of Canada's growth future, that's really where it's going to be at. So it's good that they're focusing on that. When we look at the constraints that we face, well, look, it's really going to be up to people knocking on the door of government to get the infrastructure thing going. If it's possible to do P3 plays, then I would say, that would be a key piece of advice for Investissement Québec and for entrepreneurs to harp on there. It has to be created, and if government is not the only vehicle that can do it, then it's important to use whatever vehicles that are out there to increase the infrastructure so that we can actually undertake. I think Quebec's situation is not as bad as Ontario's writ large, and primarily because of energy sector provision. There's lots of abundant energy, and it's relatively cheaply priced here in Quebec, so that's at least one thing that doesn't need to be worried about. What else would I say, though? With respect to a labor constraint, one of the key pieces of advice that I'm going to be giving around the table is don't be afraid of outbound investment. You know, Investissement Québec is supposed to bring investment into the province, right? That's good, but it's not the only game in town. And when you have constraints on the inside, it's important, if we're going to be globally competitive, to encourage our businesses to say, well, it's not a bad thing for a Quebec business to say, I'm going to take a part of what I do and I'm going to locate it somewhere else, where there are people, for example, where the cluster is, or where les chaînes d'approvisionnement are more efficient. We just have limited capacity here, and some of those things we can't do anything about. So there's lots of things that you can do about a labor shortage. You can increase immigration, you can increase the focus on accreditation, which is a real problem inside of Canada. You can retain your workers, you can train them, you can change the education system so that it's more amenable to what's going on. Most of the things that you can do take a while, you know? There are very few options. So locating offshore or increasing your mechanization, you know, essentially putting machines where people were, you can do that as well. But I would encourage businesses to do what they can focus on and to strongly consider this, because frankly, all of our economic development models are very employment oriented, which is a real problem when you run out of people. You've got to think about value creation as opposed to employment creation. And this is going to be a very needed change in mindset when it comes to the way Canada writ large approaches economic development. Employment is not the only game in town, and in fact, it's a very dangerous game to play as we go forward. So I would say keeping our eyes on how to create capacity in non-traditional ways is very, very important for entrepreneurs, and that's exactly what I'm going to be saying to Investissement Québec.
We're trying to focus with, as you know, the government, and everybody knows our government is really cash-strapped. And, but they're really focused on the spending column right now. I want to assure those of you that are here this morning, our members and members to be, because there's members and members to be.
Yeah.
That we're trying to focus on this. Getting ready for the recovery is one of our main concerns.
Yeah.
And frankly, it's one of the first times, I think, in years that I've heard the word recovery. So I think I want to applaud you just for this. We should applaud him for his general presentation.
Thank you very much. Thank you very much.